So let's talk to Eileen. Good morning.
Good morning, James.
Thank you very much for doing this. I know it's a bit like Stephanie last week. It's very early in the morning for you on the east coast of the US, but nevertheless, you've given up your time to talk to us, so we're very grateful.
No problem. I'm still on London time, so.
Okay, fair enough.
It feels good.
So I think, as usual, if you just start off by giving us a sort of bit of background onto the fund and what it's trying to achieve, please.
Yes, absolutely. So again, thank you for having me on. I appreciate the opportunity to speak with you and your audience about Ecofin and the Ecofin US Renewables Infrastructure Trust, which we refer to as Renew or RNEW, its ticker. So indeed, I'll walk us briefly through a few slides here about Ecofin first, and then more specifically about Renew. So Ecofin is a $2 billion, give or take, asset manager with a 30-year history of uniting ecology and finance, hence the name. Ecofin is part of Tortoise Ecofin, a leading energy-focused asset manager with approximately $9 billion, again, give or take, assets under management. Ecofin's mission is to generate strong risk-adjusted returns while optimizing our investors' impact on society and optimizing their alignment with the UN Sustainable Development Goals, or SDGs, as you can see there. As a firm and as individuals, we're dedicated to climate action, to clean energy, to water, social impact, et cetera. And we do that through products that include public equities, private credit, and private equity. I think we can move to slide 2, if that's okay. I won't go into too much detail here, but I wanted to give a sense of our team and of the platform that supports Renew in particular. Several members of the team, myself included, and Ed Russell and Jason Benson, are focused exclusively on private sustainable infrastructure, including on Renew. And the asset management team of Nancy Johnson, David Govert, and Marnie Kenward are dedicated to managing the solar and wind assets in the Renew portfolio in particular. Many of the other faces on this page are either Ecofin London-based employees who support research and marketing, compliance, and other efforts, or are shared resources from Tortoise Ecofin's headquarters in Overland Park, Kansas, including and especially the financial operations team led by Brad Adams. So there are approximately 45 people total, we obviously didn't picture them all, dedicated to Ecofin, and 70 people in shared services at Tortoise Ecofin as a whole. Lastly, before we move on the bottom right of the page, you'll see the names and the brief bios of our wonderful Renew board of directors. So I think we can move to slide 3. So I'll now be speaking more specifically about Renew, or the Ecofin US Renewables Infrastructure Trust. So what is Renew? Well, Renew is a UK investment trust invested in a diversified portfolio of renewable assets in the United States. Renew has the option to invest in other OECD countries, but to date, we haven't done so, in part because of the massive opportunity in the US market, which we'll get back to later. Renew is primarily focused on solar, both ground mount solar and commercial and industrial rooftop solar, and focused on onshore wind generation assets. But other eligible sectors for the fund include battery storage, biomass, hydro, microgrids, et cetera. We have a 15% bucket for sort of ancillary technologies that, again, we haven't used yet and would need more money to do so. We have a middle market focus. We believe that the project sizes in the middle market lend themselves to bilateral negotiation, most importantly, and also are too small to be overbanked. We face less competition in the middle market, in part due to our own network of relationships that generate proprietary deal flow. Renew provides stable income from its portfolio with 100% contracted revenues. And the power purchase agreements, the PPAs that underlie those contracted revenues, have a remaining average life of about 15 years. The trust is currently fully invested in 65 high quality and geographically diverse, by which I mean spread over 8 states within the United States, solar and wind projects. Our off-takers who've contracted to buy the power under these long-term power purchase agreements are universally investment-grade entities. We invest in mainly operational projects, but also some projects that are in construction or are construction ready. Since its IPO in late 2020, Renew's assets have generated approximately 430 gigawatt hours of clean electricity. This would be equivalent to about 250,000 tons of CO2 emissions avoided and about 40,000 households supplied. Our aim is to provide Renew's investors with an attractive yield and the potential for modest capital appreciation over time. Renew has paid 7 quarterly dividends since IPO, totaling 7.4 cents per share, or a current annualized dividend yield of 6.5% based on our current trading prices. My team and I manage the projects actively, seeking efficiencies and way to reduce costs. Why don't we go to slide 4 if we could. So let's pivot a little now to the ongoing and rapidly growing market opportunity for Renew. And let me just highlight, I think, some of the drivers beyond that growth, which you can see projected here on the slide. We benefit from significant long-term structural tailwinds that are poised to sort of supercharge, I would say, the U.S. renewables market in the coming decade and beyond. So as you said earlier, our competition may be a little daft, your word, not mine, but I can't say I disagree. And that's about all I'll say about that. Let me enumerate some of the more significant drivers of this growth that we're so excited about. The first driver is really government legislation, and that includes tax incentives for renewable energy. And it also includes, most notably, I guess, the $370 billion Inflation Reduction Act passed in August 2022, which has understandably gotten really all of the attention. But government legislation that's providing these tailwinds also includes the Infrastructure Investment and Jobs Act, which was passed in November of 2021, which, among other things, provided about $65 billion of funding for the clean energy transmission and power infrastructure upgrades that are needed to support the growth of renewables. And it also includes the CHIPS and Science Act, which no one pays any attention to, which was overshadowed, I think, because it was passed around the same time as the Inflation Reduction Act. And the CHIPS and Science Act, which on the face of it was geared towards supporting the semiconductor industry in the US, itself committed $67 billion of its total funding towards accelerating the growth of zero carbon industries and climate relevant research. So together, these three legislations alone represent over $500 billion of federal government incentives supporting investment in renewable energy. I haven't even included all of the state, municipal, and local incentives of a similar nature, and of course, all of the corporate and industrial climate pledges and commitments that have occurred in recent years. That includes, by the way, 22 states and the District of Columbia that are targeting 100% renewable energy or carbon-free electricity by varying targets, 2040, 2045, 2050 at the latest. So the second driver of growth is the desire for greater energy security and energy independence in the United States. This involves both national security concerns and also economic motivations, like reducing volatility from exposure to energy price fluctuations. And by the way, hence the name of the Inflation Reduction Act. It also reflects the desire to re-domesticate the production of important energy equipment and to reduce our dual vulnerabilities, first to Russian and Middle Eastern gas and oil, and then, of course, now to Chinese production of most of the world's polysilicon and PV solar panels. So we've basically gone from one vulnerability to another, and it would be good to get rid of those vulnerabilities. So the third driver, I would say, is increasing demand for energy overall, especially as we seek to decarbonize industry and as we seek to electrify transportation and other sectors of our economy. Fourth driver, I would say societal concerns about climate change, increasing concerns about more frequent and increasingly severe natural disasters, and just a general desire to save the planet for future generations my kids and your audiences included. The fifth driver, declining costs. Overall, despite sort of recent setbacks in some cases and supply chain logistical issues that we faced last year, overall, the costs of installing solar and onshore wind generation on a combined basis have declined by about 70% over the last decade, as we all know. And this is another driver that's worth mentioning. Sixth driver, and last but not least, I would say, the massive size and relative underpenetration of the US renewables market versus its peers in the UK and Europe has to be acknowledged. To give some perspective, the US power market is about 12 times the size of the UK power market and about 1.3 times the size of the European power market, according to Bloomberg NEF. So for the sake of time, I've ticked through a lot of those drivers rather quickly, but obviously happy to circle back to them at any point later. The point being that Renew's market opportunity and addressable pipeline is dozens of times bigger than the trust as it currently stands. And we have the industry relationships and the experience to identify and pursue the most attractive of these projects. I also want to point out that these structural drivers are not, and I think this is a common misperception, or at least should not be, political in nature. And they will continue regardless of political administration in the US. So why don't we move to slide 5, and I'll kind of run through slide 5 and 6 here. This just shows you a few facts about the makeup of the Renew portfolio currently, and hopefully maybe helps answer the question of why Renew. Currently, we have 65 assets, again, across 8 states, as I mentioned, and close to 180 megawatts of capacity, with long-term contracts with creditworthy, investment-grade counterparties. These are high-quality assets. They are operating and cash flowing as expected. Renew's UK trust structure gives investors, there in the UK, access to the huge US renewables sector, which is otherwise hard to find in the US market, as you mentioned, in the UK market, as you mentioned, and soon getting harder to find with our only pure play competitor inexplicably closing up shop. So Renew is differentiated by steady cash flows, by an attractive dividend yield, and by its SFDR Article 9 status. I should point out that this Article 9, sort of quote unquote dark green status, has proved difficult for other trusts to achieve or maintain, at least in the market. And according to Morningstar estimates that I recently read, less than 5% of all European fund assets can actually make this claim. So I want to point out the Article 9 status. I'll end there by saying that I hope you're as impressed with the Renew portfolio as I am, and are as excited about our prospects for growth as we at Ecofin are as well. I think we've gone through all the slides, although there may be one or two more, and we have some appendices that we can refer to as needed.
Great, thank you very much for that. That's a really good introduction. So a few sort of bits of nitty-gritty about how the fund works first, I think. In terms of, you said OECD, so you would buy assets in Canada, maybe, if that was... Could
do, yes, absolutely. We have as I said, a 10% bucket for non-US OECD countries. So Canada is definitely a contender. Obviously the tax incentives, et cetera, differ. And we really do believe that the US market at the moment is the most exciting market. In fact, you'll probably see from my bio that I've covered emerging markets for a very long time, because the returns were in emerging markets for a very long time. And now, frankly, with all of the incentives under the IRA and in the US market in general, that's flipped on its head. And the US market is the most exciting place to be. In fact, when I first started this role, I went to a conference my second week on the job and started bumping into all sorts of colleagues, bankers, lawyers, developers, equipment suppliers, et cetera, that I've worked with over the years in emerging markets that are also now switching their focus back to the US. So to tell you the truth, I'm not sure we'll ever use the non-US OECD bucket, but it's there if we find an attractive opportunity.
Okay, great. Thank you. In terms of what you're saying about buying in the mid-market, what's the sort of size range for that?
In the mid-market? Well, we have assets ranging everywhere from about 0.5 megawatt up to the wind farm, which is 59 megawatts. The smaller of those projects, the 0.5 megawatt size projects, are actually all rooftop solar projects, commercial and industrial rooftop solar projects that we bought as a portfolio, as a package. So there are 53 assets in that portfolio. They're all concentrated in the states of Massachusetts and Connecticut, and managed under an operations and maintenance agreement with the developer. So that's kind of a unique subset of the portfolio that we reach this immediate diversification of off-takers and locations in one package. Outside of that subset of the portfolio, the smaller end of the assets are about 2 to 3 megawatts, including some rooftop and some ground mount solar. And then obviously on the high end is the wind farm. So, I think that sweet spot is probably in the, let's say, 8 to 10 million on the lower end and 30 to 40 million on the higher end, should we have the capital at some point to buy another wind farm. Those are obviously chunkier assets. And or if we did a larger solar park with battery backup, that may also be a slightly larger ticket someday.
Okay, thank you. In terms of the sort of power purchase agreements that you sell the power through, can you give us an idea of sort of how long-term they are, how the pricing works, and relative to where the market price of power is, whether there's any inflation linkage, that sort of thing, please?
Yes, absolutely. So the PPAs, I think, that have been signed throughout this portfolio are very attractive. They're good, solid pricing. I would say slightly more favorable than the market today. Some do include inflation adjustment. It was interesting to me, switching back to the U.S. market. In a lot of dollar-denominated markets elsewhere in the world, the PPAs are actually pegged to U.S. CPI, so that there's a constant inflation tracker. In the case of the U.S. market, apparently that's much less, common, and a lot of our portfolio reflects that, with inflation adjustment that's generally fixed. So in the U.S. market, PPAs tend to have, if they have inflation adjustment, it's usually at about 1 to 2% per annum fixed, as opposed to tracked to CPI. In terms of the weighted average life of the portfolio, it's just under 15 years at this point, and it actually would be quite a bit higher if you looked at the solar assets on a standalone basis. It would be much closer to 18 or 20 years. I should actually have that actual number, but I don't have it at hand. The reason that the overall number is lower is because the wind asset, Whirlwind in Texas, has the shortest term PPA of the portfolio, with a remaining life of about 5 years. Now, that's not to say that we go merchant after 5 years. The off-taker is a municipality in the state of Texas that's already expressed some interest in talking about extending that PPA, and obviously there's a lot of commercial and industrial offtake potential in Texas. So there are a lot of different options for renewal, extension, or sort of change of counterparty with PPA in Texas. So that's the only reason that the weighted average life isn't even longer than it is.
In terms of who the off-takers are they utilities, companies, local governments? What sort of thing?
All of the above. There are some utilities. There are some brand name corporates that you would recognize and appreciate. There are universities. There is a big municipality. So it's again well diversified among very creditworthy and recognizable off-taker names.
Okay, thanks. Let's assume for a minute that you could close the discount and raise some more money. I think we've got a list here of potential investments. Where are we? Yeah, there we go.
We do.
So what's the sort of desire here? Is it to kind of increase the wind element? I think that because there's only one wind asset in there.
Yeah, so this, by the way, is just a representative kind of sampling. Our opportunity set, frankly, is virtually infinite. I mean, I could list a database of all the deals in the market, and you'd come up with billions and billions of dollars of opportunity. So, I wasn't intending to show the entire market. Frankly, I think based on all the drivers that we mentioned before, it's an enormous market, and everyone knows that. And even the middle market segment of it is infinite. We can increase the size of the fund tenfold and not have any problem finding investments immediately. So the intention, yes, is to grow the trust. There are lots of attractive opportunities, and given the size of the market, we're able to sort of cherry pick the best of those based on relationships, again, with developers and bankers and equipment suppliers and construction companies in the market. So this is just a sort of sampling, but it goes to show you that we have projects in different stages of development and construction and operation. It goes to show that there are large projects that are sort of under auction that we could go after, although that hasn't been our history. There are small projects that are much more proprietary. There's the non-US island project, which again, we can do non-US OECD, and if the pricing is attractive enough to beat all of the incentives in the US market, we will. And that's a proprietary opportunity. So I can say, I think we can probably work on that for a price that's right. It shows you that there's a good mix of commercial and utility solar, that again, there's also some wind and storage. So just meant to be a representative sampling of things that we're actively talking about, looking at, being shown. But I probably get new 3 to 5 new deals, honestly, sent over a week.
Well, okay. There's a lot to process.
There's a lot to process.
In terms of the sort of geography of it, just looking within the US, are there areas that are better than others in terms of like the solar resource, the wind resource, or the subsidies you get? Or, are there areas that are better than others?
Yes, absolutely. I mean, so if you go to, I think we threw in a slide, looks like slide 12 at the last minute there, just to show the comparison, by the way, of the US solar market potential versus, for instance, the UK and Ireland. I mean, you can see the solar potential there is enormous, and it's actually everywhere. You can profitably put in solar panels in New England, even though it snows part of the year, because it is really quite sunny in comparison to the UK market or to the European market. But there are obviously states that are more attractive than others. Texas. And again, let me just touch on the fact that a lot of people think there's this sort of red state, blue state, dichotomy in the U.S. market. It's really not true. I don't think a lot of people realize that Texas is actually one of the most red states, not only in terms of irradiation, but in terms of its politics, is actually the leader in renewables in the U.S. The state of Texas, on a combined basis, has more solar and wind than California and New York, two of the bluest states in the country, combined. So there, a lot of the states in the middle of the country, in the western part of the country, have very attractive solar resources and wind resources. The part of West Texas where our wind farm is located has many, many wind farms because it's very flat and goes on forever, and it's a very windy part of the country as well. So yeah, there are some markets that are more attractive than others on a resource basis, and then there are also some markets, and again, the U.S. is a little complex with the way the markets are divided up, but some of the markets are slightly more attractive than others in terms of tax incentives and other things. But there are ways to work around that. So I would say the opportunity spans the entire country.
If we think then about sort of a brand new project in, say, Texas, how much subsidy can you get for a new project now with all of the things that have come in with the Inflation Reduction Act and everything else?
Yeah, it's quite high. I mean, between the ITCs and the PTCs, which, in the past have really only extended for sort of 2 to 5 years and then hopefully gotten renewed, and you're taking a little bit of risk there that they do. Now under the Inflation Reduction Act and some of these other legislations that I mentioned, both at the federal and the state level, those incentives have been extended now for 10 years at least. And so there's much more surety in the market that not only are you going to get the high level of support, but that it's going to continue for a good period, a good chunk of the life of your project. So those ITCs and PTCs are as high as 30% or higher in some cases when you add in the state and local legislations and other incentives as well. There's credit about that, so the investment tax credits, the ITCs, for instance, there's credit available for 30% of a project cost in comparison to what was previously scheduled step downs of about 26% currently. So we're back up to 30%. And the production tax credits, now available for 10 years of an asset's life, are about $27.50 per megawatt hour for wind and solar. So they're really, very attractive PTCs and ITCs, and there are bonus credits available as well. So terrific incentives supercharging the market.
You sort of mentioned it doesn't really matter what color in terms of politics the states are in terms of what they want to do, but on a federal level, if the Republicans got it back in charge, is there any danger that they'd try and roll back any of this stuff?
No, there really isn't, and I think that's an interesting misperception that now I've spent quite a bit of time since taking over this role, just meeting with our shareholders and brokers and others in the UK market, and there does seem to be this fear that 2 years hence there's a Republican government in charge in Washington and this all gets turned around. And let's talk about that for a minute. The fact of the matter is, all of this spending, all of these incentives are currently being baked into contracts and projects and PPAs on a go-forward basis, and will be locked into those projects and not taken away. I mean, it's a little bit like Obamacare was, if you remember the history there, and the Republicans swore that they were going to turn it around and never did. You can't give a child candy and then try to take it back after they've eaten it. It's very difficult to do. It's hard to roll back these types of programs when they've been committed, they've been spent, et cetera. And also bear in mind, it's a little bit, I like to use the analogy of a pie that someone's baked. You may not have agreed to have pie for dessert instead of brownies, but the fact of the matter is they've baked a giant pie and they've put it on the table, and now you're going to want to go after the biggest piece you possibly can. So what happens is the states then put in their own incentives because they want to see that battery manufacturing facility or that solar panel manufacturing facility built in their state of Georgia or Kentucky instead of the neighboring state of North Carolina. So they're going to pile on the incentives to get you to build it there so that their workers have jobs and their state has the tax income, et cetera. So, there really isn't, once the pie is baked, there isn't a differentiation between the red states and the blue states. Everyone wants the biggest piece they can get. I read recently an interesting statistic that said Kentucky, very red state in theory, and big coal mining state, that by this time next year, there will be more workers in battery manufacturing factories than there are in the coal industry in Kentucky. And that's very, very telling, I think, of how quickly this turns around. And some of the states, Montana, Wyoming, like cowboy states, they're big leaders in renewables. They see where this is going and they've put in incentives, and So it doesn't matter. This is not a political issue when it comes down to it. It's all about economics and finding jobs for your workers.
Great. Okay. Thank you. In terms of when you're going up to try and get a new investment, first, can you explain how the deals come to you and how you sift them? And also, who are you competing with in those sorts of situations?
Sure. So, we do get lots and lots of deals shown to us by bankers, frankly, who are showing them to lots of different people. And we know that. And in fact, I think, earlier in the life of the fund, we were shown a lot of the same deals, for instance, as our competitor, US Solar. And they won some of those projects because they were a little more aggressive in the bidding than we were. So there are projects that are at auction or are being banked that, are interesting to take a look at, but they do tend to be a bit more competitive. I think the ones that we find more interesting are the ones that come through proprietary channels, just relationships. I've been looking at energy and infrastructure projects since the early 90s when I worked for Skadden Arps in the project finance team. So, I know a lot of people in this industry after 30 years. And that includes, lawyers that hear about deals. It includes equipment suppliers that know who they're selling to. It includes developers, EPC contractors, bankers, you name it, advisors. So I think the more interesting subset of the middle market are the deals that we hear about in advance, where we already have a relationship. I mean, if we go back to that sort of subset of deals, one of those projects, for instance, was a deal where another vehicle within the Ecofin universe provided some construction debt, and now we have the opportunity to buy the equity. And because we already know the project, because we've already been through certain approvals, that's the non-US island one. We've already been through certain approvals as an entity since we've provided the debt. I think we have a leg up on competition and know where to price that asset profitably. In other cases, like numbers 4 and 5 on this list, the Eco Solar portfolio, we've already bought several projects from the developer in that particular case and like what we've seen, and therefore we have a right of first offer on some future projects. So, the more attractive deals we tend to find are the ones that come to us for some reason other than getting a CIM from a banker.
You mentioned the sort of debt funding that Ecofin might put in. Are there any other funds doing the same thing as you within the kind of Ecofin stable?
Yes, and in fact, the same asset management team, and also Jason and Ed and I oversee other things outside of the Renew portfolio, and in total, this sort of segment of the market within the Ecofin universe, this private, renewable asset universe is really closer to about $400 million. There's plenty of opportunity, and there are sleeves within other funds, U.S. traded funds in the Ecofin world, where we can put renewable assets as well. And by the way, I should also say that Renew currently has a revolving credit facility available. So we may do 1 or 2 of these smaller projects using the revolving credit facility in the interim until we can get back to market and hopefully increase the size of the fund and raise some more money to address this huge opportunity in the U.S. market.
Which brings us neatly on to how much gearing is there in the fund at the moment, please?
Total of about 35%. There's limitations of 65%. There's really only a couple of projects that are levered. Obviously, many of the projects have tax equity in addition to our common equity. But the gearing is relatively low. It could be a lot higher, but we don't want a huge overhang, frankly, when we go back to market. So, I think I would maybe do that $8 million equity check, maybe a $20 million equity check at the most, but probably two of the smaller projects, 1 or 2 of the smaller projects instead. But we do have room.
Okay, thank you. And when you're putting some a new project in, how do you sort of monitor what's going on in the supply chain? I know there's been a sort of question marks around some of the sourcing of solar panels, for instance. Is that something that you actually sort of monitor?
Yes, we have to take a look at it. Absolutely. First of all, we want to be careful of where solar panels come from. Obviously, it's a huge problem in the market, as I mentioned before, that we're so heavily reliant on China, and not just on China, but specifically on Xinjiang for where most of the panels in the world are developed. And I think we're all aware that there are forced labor issues with the Uyghur population in Xinjiang, and so that's problematic. So obviously, as a sort of, with concerns for ESG and sustainability, we want to take a look at where the panels are coming from and how they're sourced, and make sure that the suppliers of our projects are following, proper protocols to make sure that that's not the case. So, yes, we look at that. We look at supply chain issues. Often, though, we're buying at a stage where we're not taking a lot of that risk, to tell you the truth. And I think that was a wise choice when the fund was structured and the rules around it were made. We really do only do kind of construction ready, at the very least, or already in construction or operating projects. And so those logistical issues, the supply chain issues, are already behind us, and we're not taking that kind of development risk. We can take a little bit of development risk under the rules of the fund, but to date really haven't done so, and it's a very, very small percentage that's allowed anyway. So those risks tend to be behind us.
Great, thank you. Do you have to insure projects against things like climate damage, sort of windstorms and fire and that sort of thing? Yes,
the projects are insured. And frankly, that's an area that I'm going to take a better look at now that I'm sort of 90 days in here and getting to know the portfolio better. I've realized that each of the projects was insured kind of one by one as they came into the portfolio. And now that we have a reasonably sized portfolio of assets, I think there's probably some opportunity to go back to the insurance companies and talk about a sort of overarching insurance policy for the fund, and look at that in different ways to slice it and dice it, and hopefully potentially cut some costs. But yes, the portfolio is well insured, and insurance is something we would always have on these types of assets.
You've been in the sort of job for a little bit now. Are there any sort of surprises that you've had about the fund, positive or negative, since you joined?
No, not really. To tell you the truth, I am very impressed. I will say that the two of the three prior portfolio managers were sort of trained and brought up in the same place I was, which was GE Energy Financial Services. So they had a group, well trained in putting together good projects, in negotiating good agreements, and pricing things right. So I am, if anything, pleasantly surprised at the quality of the portfolio. Everything is operating well. No major equipment failures to date. No major operational issues to date. I mean, there's hiccups here and there. There are inverters that need to be replaced, but these are very, very good projects. Operating very well, cash flowing as expected, paying their dividend yield, good off-takers, good developers, good EPC contractors. Everything's in place. Everything is right. It's on track and doing very, very well.
Can you talk a little bit more about the kind of operations and maintenance side of things? And there's a specific question here about stocks of components to keep plants running, I suppose, if anything breaks. But can you just explain a bit how that works, please?
Sure. It depends on the asset. So I can't make a huge generalization here. Obviously, on a wind farm the size of the one we have, there would be backup parts and supplies and components in the warehouse on site. But then there are other times when you need new gearboxes or bigger equipment, and you've got to order that in advance and then wait for it to come and reinstall it. In terms of the solar portfolio, it depends on the size, whether they would keep, backup parts, inverters, et cetera, on site, or whether it's managed by an overarching O&M. So the the smaller assets, the said portfolio in Massachusetts and Connecticut is a good example of where, that's not on a project by project basis. That would be the O&M provider who is managing inventory and spare parts for us. It just doesn't make sense to be keeping spare parts at each individual site. So, your O&M provider and your balance of plant O&M provider are sort of critical to helping make those decisions of inventory management, et cetera.
Within the existing portfolio, is there any potential to kind of upgrade what you've got at the moment to expand the existing projects?
There probably is. We're getting into more detail about that. I think, the battery technology has been exciting, and it is increasingly exciting with more incentives baked into all the legislation, including the Inflation Reduction Act that we talked about before. So I think there's probably potential for battery backup on some of our sites, or at least to incorporate battery technology with solar or wind in future acquisitions. Also, I think, again, back to the wind asset, it was acquired when it was already 12, 13 years old. And it has 5 years left on the PPA. But after that, frankly, if we had more money, we could consider repowering or other ways to enhance the value of that asset. So yes, I think those are things we will consider. I've often been asked if there's anything we would divest, and I would say no, at this point, there's not. There really are very good, very solid assets. And I think we would explore ways to add more value, as I said, as opposed to selling any of these assets at this point.
We've talked a little bit about US solar. I suppose you can't tell us the answer one way or another, but is there any chance of a merger of the two funds?
I can't comment on that. I really, I don't think US solar is listen, we're all very, very interested to see where that goes. As you said, given the size of the opportunity, it seems a somewhat inexplicable decision, but other than that, I really can't say much about US solar, so I won't.
No, fair enough. I think we'll speculate and leave you to carry on running the portfolio.
Good job. Thank you.
Good. All right. There's a couple more questions, but we could probably sort of wrap it up there. I think that's really quite a useful rundown of what's going on with Renew. And I don't see any reason. The discount widened out when the previous team left, and it hasn't narrowed in since you've arrived, and it probably should do. So I really would like to see the fund a lot bigger, because as you say, if we could get the fund bigger, it increases the liquidity of it, probably reduce the spread, to answer a question that somebody put on there, and would let you broaden the portfolio out. There's lots of reasons why this fund should be a lot bigger than it is, apart from the opportunity. So
yeah, you and me both, James. I completely agree. Let's go for 3 times the current size.
Cool, fair enough. Good. Well, thank you very much indeed for that. I'll let everybody have a quick read of the disclosure side while we talk, but thank you again for coming on this morning, and we'll get you back again maybe in a sort of year or so and see how it's progressed since then. But good luck with it all. Thank you.
That's great. I look forward to it. Thanks so much, James.
So we will be back next week, and I'll be talking to Andrew about what's happened over the course of January, because we're almost at the end of January already, which is incredible. And we've also got Will Fulton on, who's the manager of UK Commercial Property. So he'll be talking to Richard about that fund. I think it's going to be quite interesting to see what he thinks is going on within the kind of UK commercial property market. It's had a big dive, and that fund's trading a big discount, and see whether he thinks that's now bottomed out or not. And then we've got quite a full slate, really. I think we just need to get somebody in for the 17th, but that's in hand. And anyway, so have a good week, and we will be back next week, and speak to you again then. Thank you. Bye-bye.